As we're on the cusp of a mortgage crisis and a banking crisis in Canada, the regulators are finally trying to rein in the negative amortization mortgages, but it's too little too late, in my opinion. So let's get into it. Several big banks to be impacted by OSFI's new capital requirements for negative amortization mortgages. We've been over negative amortization mortgages many times on this channel, as you guys know. This article comes straight out of Canadian Mortgage Trends. They put out some good stuff which doesn't get picked up by the mainstream financial press. So what's really interesting though, and I just want to point out before we get into this, guys, is when you really think about what's going on right now when it pertains to the banking system and the regulator, you've just got to think about, why are they doing this now? Why weren't they trying to rein in these type of mortgages before that? How did they miss this dangerous product, as the Bank of Canada is even labeling it? And it's because the OSFI, the regulator, is ran by the banksters themselves. It's ran by ex-banksters, so they don't give a shit. Profit first before everything else. So it's very interesting what's happening. So let's get into it. Canada's bank regulator recently confirmed it will move ahead with new capital requirements for lenders and insurers with negative amortization mortgage portfolios. Starting in early 2024, the Office of Superintendent of Financial Institutions will require lenders to hold more capital for negative amortization mortgage balances with loan to values above 65%, which is going to be most of them, because think about it, they're not going to have paid down the mortgage that much, are they? How are they going to be paying down the mortgage that much, considering most of these types of mortgages were took out in 2020, 2021, a little bit in 2022 as well? So that's not going to be the case. Most of them, the LTVs are well out of whack. The cost for these mortgages for the banks has suddenly risen, even though when they issued them, the cost and forecast that they had and impact that that would have on their balance sheet was X. But now the government's saying, or the OSFI is saying, you're going to have to change this and hold more capital. And really, it's just token amounts. But what it does do is it makes that mortgage product no longer really profitable for the bank anymore. And it also erodes into their margins slightly. So it's going to be interesting to see. Banks are being impacted on all angles right now. You know, depositors are pulling their money out. They're putting it in bonds, GICs and other things. It's interesting. So let's continue on here and see what they're saying. So these changes were first announced by the OSFI in July and were subject to a consultation period over the summer. They will primarily impact 3 of Canada's big banks that currently offer fixed payment variable rate mortgages and allow negative amortization mortgages: BMO, CIBC, and TD. This is Canada's subprime mortgage crisis, and a lot of people can't understand this. When you really think about these type of products, they are dangerous. The Bank of Canada is actually right about this, and they are wildly stupid, and they've been done before by banks in the US before 2008. So it's kind of hilarious that Canada's banks have repeated the same playbook, and everybody is sat there expecting that there's going to be a different result, expecting that everything is going to be fine. Our banking system in Canada is well regulated, although the regulator didn't spot this, did they? So, you know, it's just absolutely ludicrous asking the banks to regulate themselves, calling it a government entity just so that people think, oh yeah, they're doing a good job. I mean, the government does a great job as well, doesn't it? Does an absolutely terrible job of everything. Oh my God, it's just hilarious. For these banks, variable rate mortgages comprise of about a third of their overall portfolios, 32 to 39%, with roughly a quarter of those mortgages with extended amortizations beyond 30 years. And those neg-am loans as well, they're accumulating interest, and they have been for quite a while. If you think about, most mortgages were triggered last year, towards the end of last year. They've been accumulating all that interest debt that people haven't been paying because they haven't even been paying down the interest. So their loan balance is actually increasing, and their loan to value is therefore increasing. So it's it's ridiculous, guys. It is just ridiculous, and not enough people in the finance space are really talking about this, calling a spade, and saying how bad this really is. While RBC does offer fixed payment variable rate mortgages, it does not allow its mortgages to amortize negatively. So that's good in a way, I suppose. Scotiabank and National Bank of Canada, meanwhile, offer adjustable rate mortgages where the borrower's monthly payment fluctuate as prime rate changes. As a result, result, both banks have less than 1% of their variable rate portfolios with amortizations above 30 years. And, you know, Scotiabank seems to have other problems. I mean, if you look at Scotiabank's stock, for starters, it's been one of the weakest stocks, and it's invested into a lot of emerging markets like Mexico, where lending has kind of boomed over the past 4 to 5 years, essentially. And a lot of that has gone into things like Airbnb. And how well is that stuff going to work out during a recession? So you've had that side of thing as well. And that's just one of many different risky things when you're lending into these emerging markets. And you've also got Scotiabank, who's involved in China. We don't know the exposure of that, but we know that BMO and Scotiabank are doing lending in China and have been doing lending for a long time. So what's the exposure on that? Who knows? And that could be what's being priced into their stock. But realize this, guys, the stock price does impact what sort of lending that they can get their hands on, because if their market cap is shrinking and their stock is tanking, lenders are going to be taking a step back and be saying, oh, I don't know if I want to lend to you. What's going on at your company? And this kind of shows you the exposure here. Canadian bank variable rate mortgage exposure. So you can see that Royal Bank has total the highest amount of mortgages in Canada. You've also got CIBC, you've got TD, and you've got the Bank of Nova Scotia. And if you look at the percentage of variable rate, you can see that most of them are actually very high. And if you look at the percentage with amortizations above 30 years, CIBC is the worst, followed by BMO here. And then the average is around 24%, which is still a crazy thing. And then you've got all these capital ratios, which I don't really pay much attention to, because all this stuff is just fluff to make you think that everything is okay in the banking system. And it's like I said, you have to look at the OSFI and think, well, hold on a second. They completely missed this product, which is so-called dangerous. It's a dangerous product. And now they're coming in after the fact, when these have been negatively amortizing for essentially a year now, and they're starting to impose regulations. So it's too little too late. Wouldn't it have been a better idea to try and regulate this before it happened, not after the fact? I mean, talk about late to the party. It's exactly like the government, and it's exactly like the Bank of Canada. They're just always late to the party when it comes to everything. So impact on banks to be manageable, Fitch says. In its own report, Fitch said the capital adequacy requirements, CAR, for the banks are likely to be comfortably absorbed. And you guys know how I look at the banks. I look at their loans, I look at the amount of liquidity that they have, and I think, you know, if they have a default of around 10 to 13%, are they going to be able to handle that? No, none of the banks in Canada would be able to handle that. They do not have enough capital on hand, and not only that, we don't even know what sort of assets they're holding. Could be completely overvalued garbage that isn't being marked to market, like was the case with a lot of the banks in the US. I laugh at these regulators, I really do, because, you know, these regulators get it wrong, and Fitch was part of the whole 2008 debacle. They were essentially involved in a lot of the fraud. OSFI has repeatedly voiced its concern about fixed payment variable rate mortgages, first singling them out in its annual risk outlook for 2023 and 2024. Again, so they knew about these products, but they failed to do anything about them. It's only now, where the problem has got so large and it looks like it might actually have an impact on the financial system, that they're actually starting to turn around and say, oh yeah, we better do something. So it looks like we're doing something here, regulating the banks, when we're really just not doing anything. We're just taking cues from what the banks want us to do. It's just virtue signaling 101, like we see with the government. It's just absolutely hilarious. Most recently, during a testimony before the Standing Senate Committee on Banking, Commerce and the Economy earlier this month, Routledge said increasing mortgage balances associated with negative amortization increases their vulnerability and increases the risk of default. The variable rate product with fixed payments is a dangerous product in our view, because it puts the homeowner in a position of an extended period, not always, but in this environment certainly, it can put the the homeowner in a position of paying a flat rate of, let's say, $2,000 a month, and the interest on the mortgage is $3,000 a month. And we covered that last week and why that is so bad. But you have to think about that for a second, because that is insane when you really think about it. And people's balances are growing. And it doesn't take a rocket scientist to figure out how bad this could possibly impact the financial system and the banking system. But, you know, here we are, and they're trying to regulate it. But it's already mostly happened and unfolded. And we know from 2008 where this goes. So it's kind of interesting. And we're going to go to that right now, because I want to show you this, because there's a lot of myth that surrounds 2008 in the US. Most people think it was a subprime event entirely, and that's not the case. This report came out via the NBER. It was released in 2015, and it has some interesting insights that I'm sure us up here in Canada going through a similar turmoil will find very interesting. So first of all, we've got this chart here, and let me move it so you can see it here. So basically with this chart, what you can see is that prime mortgages resulted in more foreclosures than subprime mortgages. So it's often the belief, because of things like The Big Short, that subprime really caused 2008, and it was all a subprime crisis. It was all these bad loans that were written, when it was actually a smaller percentage than you might know or think. So, and we'll get into that right now, because it's very similar when you put it in the context of Canada as well, because Canada, going through a similar thing, has a lot of fraud in the housing market, as we know, and we'll get into in a second. So many studies of the housing market collapse of the last decade and the associated sharp rise in defaults and foreclosures focus on the role of the subprime mortgage sector. Yet subprime loans comprise a relatively small share of the US housing market, usually about 15% and never more than 21%. Many studies also focus on the period leading up to 2008, even though most foreclosures occurred subsequently. And that's interesting too, isn't it? Because that would be the case with Canada as well. And you would probably see around about a very similar percentage, 15 to 21% would be almost identical in my opinion, if not higher in Canada, for the subprime portion of the housing market. And that will be people with insured mortgages. These are people with government subsidized mortgages. They're subprime. It's just they're called insured, but they wouldn't be there if it wasn't for the government insurance. You know, in the UK, you will find it very difficult to get a loan with 5% down. There is no insured mortgages or anything like that. And because the banks got bruised and battered by 2008, they really don't want to lend to people who are putting that minimal amount down, because they know the risk of them defaulting, walking away from the home is much larger, and they really don't have the funds, probably don't have the maintenance money and everything else that goes along with the house. The probability of default just goes up and up the less money you put down. And that's what I'm trying to tell you. The people who put less than 20% down, they're insured by the government, which creates massive moral hazard and is essentially subsidizing the subprime mortgage market in Canada. And, you know, if it all blows up, who's going to be on the hook for a lot of that? It's going to be the taxpayer, even though it is an insurance policy. And if the banks are found to not be doing their due diligence, then they will be on the hook for it as well. So it's interesting. The researchers find that the crisis was not solely or even primarily a subprime sector event. It began that way, but quickly expanded into a much broader phenomenon dominated by prime borrowers' loss of homes. And this is so similar to the situation you have right now. The people who are most at risk of defaulting are those with the insured mortgages right now. Those are the ones that are the real problem. But later on, you'll get the prime ones, because essentially the prime borrowers, they've just got more money. They've got more room to absorb it, even though they haven't got that much room. And they're just going to come later, because it all comes in sequence. If you think about it, the weakest borrowers default first, the weakest people go first. And that's exactly what you would expect to see. There were only 7 quarters all concentrated at the beginning of the housing market bust where more homes were lost by subprime than prime borrowers. In this period, 39,000 more subprime than prime borrowers lost their homes. This small difference was reversed by the beginning of 2009. Between 2009 and 2012, 656,000 more prime than subprime borrowers lost their homes. Twice as many prime borrowers as subprime borrowers lost their homes over the full sample period. And what you really have to think about with this is you have to think about the quality of the borrower in Canada. You have to think, is the borrower in a real good place? Is the borrower in a better place than the US borrower was back then? And the reality is, no, they're not. So there was a lag with the unemployment rate of about 6 to 12 months in the United States during the housing bust in 2008, but it could be even less in Canada because people just have not got that balance sheet capacity, and rates are higher and they rose faster than they did in 2008. So it's interesting. On the back of this, guys, once again, I wanted to highlight this to you. We've got this mortgage fraud that is going on, and I just want to read you this again to refresh your memory from the Equifax report. So basically, the report suggests the uptick in fraud is being driven by financial pressures faced by consumers and by bold new schemes being used by fraudsters. In the automotive sector, fraudulent applications have risen by 28% in the past year. Similarly, the mortgage sector has experienced an 18.8% year-over-year increase in the fraud rate, with first-party fraud accounting for 54% of all fraud types observed in Q2 2023, up from 46.5% in Q1 2023. So mortgage fraud is now most of the fraud, guys, that we are seeing. So that kind of shows you how bad things are. And they're doing this because of financial pressures. They know that they're not going to qualify for the home unless they commit fraud. It is just a toxic combination, in my opinion. And as you see interest rates remain high, people are just going to get more and more stretched. As you guys know, you're going to see the unemployment rate. We're already seeing it, in fact. The unemployment rate is going to continue to climb. It may go down, but it then will go up again. And eventually, you're going to see this rise drastically, just like we saw in 2020. And that is when the shit is really going to hit the fan. But I want to know, guys, what do you think the government is going to do? And what do you think the banks are going to do? Because here's a thought that I want to leave you with in this, is the way I see it, there are two ways that this can be bailed out. Stimulus, which goes through the consumer. So they say we're going to give mortgage relief payments or whatever they call it. We're going to give this UBI essentially like they did in 2020. They used the 2020 playbook again. So that will just equal more consumer price inflation. And the people are so destroyed right now in Canada. They've been so wrecked by the past couple of years of inflation. That would essentially lead to a very bad depression, in my opinion. Or you will get the government who will just bail out the banks. I don't know which one's going to happen here, but it certainly feels to me like they would gravitate more towards that stimulus program, because essentially it doesn't have the stigma of direct bailouts of the banking system, even though it is essentially an indirect bailout of the banking system. So if you're looking for a VPN, which you need to get around Bill C-11 and the censorship laws in Canada, check out ExpressVPN below. Anyway, I want to thank you so much for watching this video. If you've enjoyed this video here, you might like this playlist here. You might like this video here. Thank you so much, and I will see you in the next video. Take care, guys. Bye-bye.